Hi, my name is Taylor Woolley, and today I'll be doing a quick presentation on the secondary mortgage market. So let's just dive right in here. So first of all, what is it? The secondary mortgage market is where banks and investors they go to buy and sell mortgages. We'll get more into what that means a little bit later, but first there's three different parties. There's the originators, which are basically the initial banks, the really the face of who the consumers are going to see. Aggregators, which will bring together a lot of mortgages, and then investors who are going to be buying up and investing into these bundles here. So that's basically what the mortgage market consists of. It's the secondary mortgage market. It's behind the primary mortgage market, which most people don't see the secondary mortgage. And so the originators are the loan grantors, the banks. So they're going to approve the customer loans when you need a house loan. That's who you're going to have contact with. And then these banks, in order to get more funding and to be able to have more loans, they will aggregate or they'll bring together a bunch of loans and have a bundle. And they will sell those bundles to investors. That's the third bullet point there, which are companies, banks, other private investors as well. And so they'll buy parts of the mortgages, and so that the originators, those initial banks, can keep lending out money, and really that just keeps making more money for everybody because of the way that interest works with loans. The more loans we get, the more money we can make, and it lowers the risk for them as well. And so, how is it doing? Really. So this is something I've never heard of this market before, so it was really cool to do some research on it. And the one big piece of information that I think is worth sharing on this market, this industry, I guess, is really kind of relies on the economy. And the recession of 2008 was really hard because it put a lot of the investors pulled out because of no one was lending any money, and so there's no money to be made in that industry because everyone was kind of scared, and so I'm sure some of you remember those times. But since then, since the market's been going up really well, lending has increased, which means that there's a lot more, cash out in the world. A lot of people can take out loans more, which means it keeps the economy moving, which is really good for just the way that we live. And so, I mean, of course, with all debt that comes out, debt's not always good, and so having high amounts of consumer debt can lead to crashes in the marketplace and everything. But having a good balance, such as almost like we're in right now, I guess people have been talking about a market crash, but having more loans means keeps the economy moving, and that is the point of secondary market.